You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call around these parts Ye Old Options Insider Radio Network. Quite a few programs to be enjoyed on the old network, including well over 100 archived episodes of Volatility Views. And where can you find all of that volatility goodness? Well, no shortage of places, including the mothership, the flagship, theoptionsinsider.com. Surf on over there. Check out some of the articles, the unusual activity alerts, of course, the breaking news from the options market. And while you're there, of course, click on that Insider Radio Network tab on the top left of the page, and the whole network will pop up for you. And then you're off to the races. If you want Vol Views, click on the Volatility Views tab, and there you go. Or you can pick any other show till your heart is content. You can download, stream, have a good time. And, of course, you can also find us in all the usual outlets, iTunes, Stitcher, AHA, Mobile, TuneIn, you name it, we're out there. And if we're not, let us know. If you have some weird esoteric outlet you like to listen to stuff on, we'll make sure we add it there as well. And if all of that is just too much work, you can't be bothered, then just grab our mobile app. It's all baked in there, and you can build your own playlist, stream, download, ask questions, have all sorts of fun right there in the old mobile app, available in the iOS store, the Android, Google Play Store, and the Fire OS store. So no shortage of places and no shortage of ways for you guys to enjoy the program. And joining me on the old program today, the major domo of all things derivatives over there at BGC Partners, Mr. Jared Woodard. Jared, welcome back to the old program, sir.
Hey, I'm really glad to be with you.
Glad you can make it. It's been a busy week of conferences, last couple of weeks here in the old volatility and trading landscape. Of course, we had the RMC, the SIBO Risk Management Conference, about a week and a half ago. Of course, this past week, I just came back from tooling around Florida for the big Futures Industry Association conference. That's where all the global exchanges and brokerage firms and trading firms all head down there to discuss all things futures and derivatives. So there's been a lot of stuff brewing. And unfortunately, Mr. Jared, you were stuck in New York the entire time. Hope the weather was at least decent for you there.
Oh, we've had such fantastic, beautiful weather for the whole year. In fact, just like mild and friendly, no complaints whatsoever.
I will say this: it hit about 55 or 60 almost in Chicago when I headed on down to Florida for the conference, and it kind of lost some of its luster because about a couple days before it was 12 degrees. That would have been really fun to go down to Florida, because then you can, of course, call back to your wife and make fun of her and tell her you're in 75 degree weather. And that's really the whole point of doing that, right?
Yeah, absolutely.
So the conference lost some of its luster from that perspective. We'll be joined in a little while by the greasy meatball himself, Mr. Mark Sebastian. He's a wee bit fashionably late, as always, but we're not going to wait from him, or not going to wait for him. Oh, no. No siree, listeners. We're going to dive right on into the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, that music means it is time for the old Volatility Review. This is, of course, the portion of the show where we break down what was going on, what caught our eye in the week that was from a volatility perspective. And I should mention, listeners, we are recording this, of course, on Friday, March 13th, the ever auspicious Friday the 13th. And the market's certainly reacting that way, at least so far. Most of the major indices selling off fairly aggressively, about 1% or so on the day. The S&P hovering right around that 1% down mark. The Dow a little bit off a little bit more, about 1.2%. And the Q is a bit of a laggard, only about 0.75 of a percentage point or so. And VIX Cash ticking up about a point to 16.5 or so in that range. So that's where we are as we are discussing the show. And Jared, I will give you pride of place, sir, because as I mentioned, I was gallivanting throughout conference land through the entirety of the week, so I didn't have a chance to really catch in on much of the trading action. So I shall defer to you in this segment, sir. What really caught your eye in the week that was from a volatility perspective?
Well, we had a lot of large moves earlier in the week. Lower, and stocks have been down overall since the beginning of the month, and bit of a bounce on Thursday this week, and then, as you mentioned, another very large sell-off during the day today on Friday. There was a headline that kind of went across with Russia announcing some kind of a news to be delivered, asking all the journalists in town to stay put. So there's been a lot of speculation on the desk today about what that might be and what that might mean. And then earlier in the week, it was kind of mildly entertaining. We trying to ascribe causality to day-to-day moves, whether it was a strong dollar or rates policy expectations, Chinese regulatory and political decision-making, the usual grab bag of hopes and dreams and attempts at causal relationships.
The usual grab bag of hopes and dreams. I love it. Only you, sir, would come out with such a description of the week that was from a vol perspective. Spoken like the true philosophy major that I know you are at heart. And speaking of philosophy majors, he is not one, but he's joining us nonetheless. He is the greasy meatball himself, Mr. Mark Sebastian from the land of the pit. Mr. Greasy Meatball, good to talk to you, fashionably late, as always.
Good to be here. Glad to be back in Chicago. I brought the Carlsbad weather with me. It's really nice.
Yeah, it is nice. I just came back from Florida myself, and it doesn't feel like I really changed that much. It's only about 10, 15 degrees difference, so I'll take it.
Indeed.
And speaking of your trip out there to California, I did have a chance when I was traveling to catch up on a few of your interviews from the Risk Management Conference, and they came out very well. Well done, sir.
Well, thank you. I think I got one more than I did send you, actually, but we've got I had a lot of really interesting interviews. I had a fun one with Andy Nybo from Tab Group.
That man hates to talk. He can't get a word out of that guy.
Exactly. And John Superson was interesting. He runs a market making and networking firm, and there were just a lot of and I got a good one with Ben Lonergan from Convergex, and so there's a lot of really, really good interviews that we were able to do. Bill Speth and I had a nice chat. So I think, as those come out, I think people will find that, the little 8-minute bites are worth listening to.
And listeners, of course, you can find those right here in the Volatility Views feed, of course, in our network feed, as well as in our special events conference feeds as well. So no shortage of places for you guys to find those interviews, and they will be joined shortly. I did a legion of conversations myself at the FIA show this past week, so there'll be more interviews to come with various movers and shakers in the world of derivatives. So if you're into those, you've got a feast coming down the road for you. Stay tuned to the Options Insider Radio Network for those. But Mark, we were just breaking down the week that was from a volatility perspective. Now that you're back from your travels, what really caught your eye this week from a vol perspective?
I would say the big thing is the lack of overreaction out of volatility. We've had 3 days this week with some real movement, and then another day last week. And, the VIX is just kind of hanging around 16.5%. It's basically saying, 1% is it. And, one thing people seem to forget is, 20 points was a large move 500 points ago in the S&P 500. And we need to kind of get used to the fact that, a 20-point move is 1%. That's not the end of the world, right? In order to, a really strong move is going to be heading toward 30 and 40 points going forward. And that's kind of, really a piece that people need to kind of reset themselves to. Now, one area that is getting crushed, the RSX is down 3% right now as we're talking, and the dollar, holy dollar, that has been unbelievable. So, the dollar is, basically every world currency is crashing against the dollar. And, it's all around this Fed stuff. That's actually the big driver. If oil looked like it was basically settled in, and now with the dollar rallying, it's starting to move, oil's weakening again. All commodities are really weakening again as the dollar just, basically explodes higher. People that think, that just like bonds can crash up and down, the dollar can do the same. So just real interesting set of circumstances moving markets today.
Yeah, you mentioned the RSX. Jared, of course, mentioned that as well. It is taking it on the chin a bit today, down about 3%, right at 16 even as we're recording this right now. Listeners, of course, that's coming on the heels of this kind of surprise news coming out of the Kremlin of this quote-unquote mystery announcement they have coming. No one really knows what the heck they're cooking up over there, so we'll be paying attention. Maybe we'll even get a chance to see this during the show. I'm not sure if they're going to I'm not sure if they're going to announce it while we're recording. We'll see, listeners. Of course, by the time you hear this, we'll know what this quote-unquote mystery announcement was. But still, interesting stuff afoot here in the old markets. And, and Mark was alluding to the fact that we had some interesting moves this week, and yet it wasn't the big overreactions perhaps we may have seen in weeks past. The underlying market moving fairly aggressively this week, including a few days of some aggressive sell-offs, including today, and yet we're not seeing dramatic pops in the realm of volatility. Like I mentioned, we're selling off 1% today. VIX Cash up about a handle or so throughout the week. We even had a relatively tepid range from an overall VIX perspective, just a little bit shy of 15 up to about a little bit north of 17. Given all the relatively dramatic movements we saw in the marketplace, that is a little bit interesting in and of itself. Of course, looking at the old skew, how people are shaping up out there, what they're positioning on. It's coming in on a little bit light here, about 121.5, which is not surprising given the fact we've had some downside moves of late. Some of that Skew Index tends to come in whenever we see those types of movements. And looking a little bit farther afield to what's been cooking out there in VIX land, in particular, the VIX options, despite the fact, again, like we said, that there was a relatively robust week from an overall underlying movement perspective, the options weren't really lighting it up. In fact, pretty much every day this week, obviously today's session is still unfolding. We're only about 230,000 contracts in so far, but every day this week pretty much at or substantially below the average volume out there we've been seeing of late, which is probably around somewhere around the 470,000 contract level or so. So looking at the numbers here so far for this week, and again, overall open interest is growing. We saw, of course, a lot of that come in after expiration, starting to claw its way back to right around the average level. Usually hovers around a little bit north of it. We're at about 5.5 million contracts outstanding, about 3 3/4 on the calls, about 1.85 on the puts. So getting a wee bit call heavy again, but nowhere near the levels we've been in the past. Looking at what's catching people's attention, what people are actually trading out there in VIX options land, puts leading the charge again this week. It's been a while since we've seen puts on top, at least for a few weeks. The March 16 puts in particular leading the charge with about 187,000 of those to take the number 1 spot, then followed by the March 23 and 20 calls for the number 2 and 3 spots with about 168,000 and 165,000 respectively. Moving on, number 4, the March 14 half puts with a whopping 135,000 contracts open interest. And number 5, the March 30s, the ever optimistic, ever resilient March 30s, always on the list. It seems like the March 30 somewhere in the top 10, hitting in at number 5 this week with about 128,000 contracts open. The somewhat less optimistic March 20s following up at number 6 with 125,000 contracts open interest, and then the March 18s also right around the same level with about 120,000 contracts. And number 8 is the March 27s, a little bit more optimistic there, 117 open on that strike, followed by the March 15 puts, 116,000 contracts, and winding out the top 10, the relatively meager March 16 calls with about 110,000 contracts open. So there are some puts, but only about 3 of them on the old top 10 strike. And again, another surprisingly light volume week, given some of the interesting movements we had. Of course, the other developments we've seen in VIX options, we've seen, of course, starting on the 2nd, the VIX options having extended hours, and talking to the SIBO guys this week down at FIA, they were at least surprised and happy with the early volume, even if in those hours, even if it isn't really dramatically contributing to the overall whole. We also saw SPX options starting their extended hours last week as well on the 9th. I will say, speaking of things, SIBO, I was talking to those folks down there, and of course, at the FIA show, we're always talking on this program about alternatives, trading products that are out there, alternative indexes we'd like to see and get access to here a little bit more, particularly from an options perspective. And they did announce they will be listing MSCI options coming relatively soon if they can get all the approvals on there. That was kind of the big news coming out of the conference from an options perspective. So that'll be kind of interesting. I know, Mark, I'm not sure if you follow MSCI a lot. Jared, do you watch MSCI a lot, and does this prospect of listing options on them appeal to you going forward?
Sure. I mean, yeah. I think the usage of these products is going to be the main question I have is how they're going to be taken up in relation to the options that are already fairly liquid on the corresponding ETFs. I know that for some of these products there may be not an ETF equivalent. I'm thinking of like the FTSE 100. Maybe some of the other indexes may be genuinely new here as well. But a lot of the MSCI indexes have ETFs and then have options on those, and so I think that's the question that some folks will have is whether these new products offer maybe good liquidity at a larger size, which might bring some cost savings, or what. I mean, some of these are familiar indexes to everyone, and I wonder about the use case.
I think they have some tax benefits that are potentially interesting, and then the larger size maybe works toward an institutional audience or a fund that is maybe looking to hedge an EM position in a less expensive way, or an EFA position. So yeah, I mean, I agree with you, Jared. They're basically adding a cash settled version of these things. So what's the same question would be, what's the use case for SPX? People use it, and so there you have it. So,
and you're right. The tax benefit there is potentially pretty meaningful.
Exactly.
This is not advice.
Yeah, no, it is not. I'm not a tax professional. I do not play one on TV, but there may be some potential tax benefits to a individual investor. But consult your accountant. I think that's interesting. Mark, one trade that actually went up in VIX that I thought was kind of interesting, and it was the first time I'd seen one of these in a long time. We had a guy buy like 40,000 of the April 50 calls a few days back, and we had not seen the big buyer of the at the 50 and 60 strike in a long time. Makes me wonder whether last week there was some sort of, either somebody was hung on some variance or somebody was hedging off a short-term variance trade. But it was the first time I'd seen one of those trades in probably 6 months.
Yeah, and they did those for like 8 cents as well.
Yeah,
that's true.
Yeah, 8 cents on 40,000 of the April 50 calls. So, I mean, I'm thinking it's associated with some sort of trade.
Yeah, it's true. They actually are a little bit late this year. I used to joke in previous years of this program that February was when we saw all the crazy paper that would go up. In previous years, we've joked about, things like Feb 70s and crazy nut job called buys out there in VIX. These, by comparison, are a little bit more muted, perhaps a little bit more, dare I say, reasonable. They're only out to April, and they're only the 50 strike. But you're right, about 44,000 open on that strike. Looks like another 2,300 have gone up today. It might be related to a spread with the 842 halves going up 1,000 times as well. So maybe someone doing a little bit of a ratio, taking advantage of the big trade that went up out there. But yeah, you're right. It's been a long time on the show since we've seen these sorts of, shall we say, extremely optimistic type trades. And you're right, they probably are hedging something OTC. You don't typically come out and just naked gobble up a bunch of 850s and hope for the best. Usually there's something else you have on against it out there. But still, it has been a while since we've been able to parse one, and it's a few months late this year. Usually it's around the Feb cycle that we start talking about this. So they were vacationing. Perhaps they were off at either RMC or FIA, and now they just got around to making their trades this week. Either way, interesting stuff. We love to have those on the books so we can keep an eye on them and kind of speculate and see what the heck they were actually up to for the rest of the week. Speaking of some other interesting developments coming out this week, I think more perhaps salient to the listeners of this program from a contract perspective. I had a chance to sit down with Pat Fay. Listeners of this program know he's the Russell Global head of derivatives. He's a big part of this show in terms of coming on and supporting it. And we had a chance to chat down at Boca. And one of the things I got him to talk about was the potential future for some more volatility products coming out of their joint venture, their merger, their deal there with the London Stock Exchange. Of course, that brings FTSE into the equation. We all know Russell, even last year, before they were part of that deal, were making big forays into the world of volatility products with RVX, which hasn't really lit the world on fire yet, but is gaining some traction. And now I think the possibility for future indices out there and vol products on those, like the FTSE, things that actually trade fairly aggressively, are pretty interesting. They also have brought a lot of their stuff in-house over there to the SIBO, which is kind of interesting from an inside baseball perspective, because they had listed those on a bunch of different exchanges, and now it's pretty much everything over there on the SIBO. So that'll be interesting to see how that works out. And speaking of new products and people getting a little bit of interest, I also had a chance to sit down with the folks, you remember them from this program, listeners, of course, Bob Kraus, the CEO of VolX, and they have done some of the startup dance here in the space. They were on this program for a long time with their vol contracts. Like a lot of startups, they ran out of capital, but now they're back in force, and they were down there really shopping their new contracts around. Of course, they've announced a big deal with Box. They're going to be listing them exclusively with Box in terms of domestic SEC-regulated type products. But they did seem, from talking to them, of course, all these interviews will be coming up later on the network, listeners. You can check them out for yourself. But you can see there's a lot of interest from both domestic and international exchanges, as well as some chats with some interesting partners. Let me just say that people you may not expect would be interested in a product like the VolX realized volatility contract. I can't say who they are because those talks aren't finalized, but some interesting stuff cooking over there. We may see those VolX contracts coming to light and trading on a lot more products, perhaps even sooner than we thought. I know they're looking at SEC approval sometime in the early May timeframe, and it looks like the comment period is going pretty well for them. So they expect, through all things being held equal right now, to get approval sometime in early May, and might be able to start trading these realized vol contracts on an actual product you want to trade, SPY, as opposed to previously on the euro, sometime hopefully soon in the next few months. That'll be kind of interesting. I know for a lot of our listeners out there who've been writing in asking, what's going on with those guys, it'll be interesting for you guys to get a bit of an update. And Mr. Jared, I know you like to pay attention to all things international vol. We were just talking about how something seems to be afoot out there in Russia, so we'll probably reserve comment until we know what the hell actually is going on out there with the Kremlin. But aside from today's mystery announcement, what else has been catching your eye from an international vol perspective?
The trend lower in the euro has been a big theme lately, and that's showing up in the options, as you would expect, on the currency. But it's also been one of the contributing factors to good performance this year in European equities, and so you've got less of a volatility risk premium over there than we had seen in years past. There's also been a little bit of a change in fortune from some prior shows that we've done, where U.S. indexes were priced pretty aggressively in terms of volatility skew, where the downside puts were carrying a fairly notable premium to corresponding calls, and I think that's reversed course quite a bit. In terms of comparing the U.S. to the rest of the world, and now there's some indexes in Europe and Asia that seem to be priced with a little bit more of a skew premium involved. So overall, things have quieted down in Europe in a really positive way. You've got elections coming up in the UK this year, and so some catalysts on the horizon. But yeah, overall, I think that there's, if you're really looking for bang for your buck or for really excitement, there's not as many places. I mean, emerging markets, especially emerging market currencies, have been pretty exciting this year. Everything else is calming down a bit.
Now, speaking of places where things aren't calming down so much, we had another interesting week in crude. You probably can do a whole show every week just about crude vol and what's going on out in crude land. Talking down to this futures conference this week, everyone and their mother was talking about crude all week, so it's really still very much top of mind for pretty much everyone out there. And it was a fairly volatile week yet again for crude. Some interesting intraday swings on a lot of different sessions. We saw a couple different sessions where we had some early gains going on, then they get clipped by a variety of different data. We saw reopening of the Houston shipping channel. That, of course, weighed on it. Potential for ending that ongoing refinery strike also weighed on crude. We saw some boost coming out of some of the dollar data and, of course, the February sales data impacting the dollar, which, of course, helped crude. So we saw a lot of push and pull out there in crude land, which is kind of par for the course what we've been seeing the last few weeks. Still remaining in that range that people have been predicting and trading very heavily around the crude spread. Of course, the Brent U.S. crude spread, the widely held, widely tracked, widely traded spread out there, also widening a bit by a little more than $1, actually, over $10 a barrel now. That's its highest since late last week. So interesting stuff afoot out there in crude land. Again, we probably can do a whole show. Maybe we will one day about all things crude. But before we get to that, Mr. Sebastian, I know you like to watch all things crude, as well as, of course, the various ancillary ETF products, XLE, oil, all that fun stuff out there, USO, out there in the old pit chat. So what really caught your eye this week from a crude perspective?
I thought we were calming down. I'll be honest. I sat here and watched the OIV and the OVX both print below 50 for 4 days in a row. Then the dollar starts getting really strong, and then who knows? Who knows where oil goes, but I think this is more of a dollar story than an inventory story. I think any buildup in inventory is probably priced in. It's just how much stronger is the dollar going to get against everything, and that's probably what's really driving things down. I'm surprised Brent isn't taking on the chin harder than WTI, to be honest.
Yeah, looking here at some of the indices you were just talking about, of course, OVX being the crude, the USO, vol, OIV being more of the WTI crude. Both of them sharp spikes today, up about, I know you love percents of percents, but 11%, pretty roughly on both, about 5 handles on the OIV alone. So vol creeping back in with some fervor. I think maybe exploding back in more like it. And you're right, earlier in the week, it did seem kind of like the vol drift was in, kind of settling in, and towards the latter portion of this week, bam, vol coming back in with a vengeance. So all those people out there who maybe been kind of starting to lean on the aggressive vol selling train out there in these products, thinking we're kind of range bound, vol is going to come in. A day like today may be an unwelcome surprise to those folks. All right, thank you for that. And now it's time for us to keep on rolling into personally my favorite portion of the show, because it gives you guys a chance to shine here on the old program. It's time for the old volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail. This is indeed the portion of the show where you guys get to take the reins here, get your questions or comments featured here on the show. Got quite a few here. We'll see how many we can get to. Let's start off, actually, let's start off down at the bottom here, an interesting one. This one comes from Carl. I don't even know how to pronounce his last name. Jedredes. I'm not sure if Carl, if I'm butchering your name, please forgive me. And he writes in kind of a topic we talk a lot about on this program, of course, term structure out there in VIX land. He writes, what is the traditional slope of the VIX futures term structure. How much premium do the long-term futures typically exhibit over the front month? For example, 6-month future at an 8% premium over the front month future. And also writes when the VIX term structure is flat, a little bit hard to read here, or even backward, does this typically benefit ETPs like VXX that are forced to rebalance on a regular basis? Interesting question, Carl. We talked a lot about that term structure of late. In fact, you mentioned the traditional slope. Of course, it is contango. In fact, we talked recently how that's so widely viewed now and so widely held that when SIBO's numbers were a little bit less than an analyst expected, they actually blamed the lack of that contango term structure as really being a demonstrable weight on their earnings. Whether you buy that or not, whether you think it's just an earnings excuse, they actually put it out there for mass consumption. So that is a very widely held thing, so widely held that they leaned on it during their earnings call. They said that the term structure is actually much more flat than it had been in recent months, and that, of course, there wasn't as much roll trade out there, and that, of course, in turn hit their transaction income as a result. So traditional, of course, being that strong contango. Jared, Mark, do you guys have a ballpark figure you like to throw around for how steep that slope usually should be on a given, let's say, not saying the aberrant circumstances, just in the average? Maybe Mark, we'll start with you.
I mean, I think it depends on where the actual VIX is at the time. Typically, the lower the VIX is in percentage terms, the bigger the contango, but the actual dollar for dollar spread will be, smaller. But, it really depends on the kind of days to expiration, how far things are apart, and how close the next month is to becoming the front month. So, I don't have a typical contango that I like to follow, although they definitely do hold some ranges. And honestly, I don't like looking at percentages. I don't think that gives you the information you want. I think you get a lot more out of kind of raw points and where we are in the cycle than you do out of kind of monitoring a percentage of contango constantly. Jared's probably believes the exact opposite, which is why two people can look at something so differently and still trade.
Yeah, I was going to say, I bet you Jared's going to spit out some exact number he looks at right now. So go for it, Jared. 6.2%, go.
Yeah, you guys are, no, I agree completely. You guys are way off. You're exactly right. So,
oh, nice.
No, I mean, I agree that looking at it in terms of all points makes a whole lot of sense and is a lot more practical. In terms of the historical ranges, man, I should know that, and I don't, but I can look it up for next week. But one thing that Mark said that's right is that you have to define your terms, because the range between like a 6-month and 2-year curve, is going to be fairly narrow. Between the front month VIX future, let's say, and the 6-month future or the 3rd-month future, that's going to, obviously be a much wider range over time. The average difference between those two is going to be larger. I think between, say, like a 6 or 9 month future and then say the front month contract, you're looking typically at maybe 2 to 3 to 4 points most of the time. But I'll look it up and figure out what the range is between, say, 3 months and 1 year, for example, for next week. I'll make a note of that. But in terms of using it, which the listener asked about how you use that, I mean, this is a good question. It's something we've talked about quite a lot on the show. This isn't like a new development, and I think I have this like a standard point that gets made in these kind of conversations, which is everyone likes to talk about term structure in VIX futures, but there's term structure in any kind of set of contracts that have different times to maturity. There's that in SPX options, in options on any equity that are listed, and in fixed income, there's the yield curve, which involves a lot of the same underlying core concepts and factors. And so being able to trade things with different maturities and the expectations that are priced into those is a fundamental core concept in trading, whether or not you ever look at VIX.
Yeah, he brings up the specific example. First off, I like that our listeners, when they give us homework, I think that's a good thing for us to get some homework for next week's show. So Jared's got some homework. I think that's a good thing. Well done, Carl. And he mentions does it benefit things? He specifically mentions VXX, of course, very widely held, very widely traded VIX or ETP that we've slammed, rightly or wrongly, depending on your viewpoint here on the program. But one of the reasons it is so problematic is because it does get demonstrably impacted by those periods when that contango is very sharp, very, very steep. And so in your hypothetical scenario where that term structure was flat, where there was no, as Jerry likes to say, time value of money built into that term structure, yes, VXX would benefit, because one of the things that hits them is they're constantly paying for expensive longer term volatility, and then selling cheap front month volatility or somewhere in that range. And that, as you can probably do the homework yourself, if you do that over and over again, that's going to impact you. And so if you had this hypothetical flat term structure where nothing had any premium, VXX would probably be a much more attractive product. I know to me, a lot of the studies we mentioned here on the show, that impact of that is somewhere in the 4 to, on some very aggressive months, 15% range on VXX in terms of how much that roll yield negatively impacts the product. So on a flat term structure, I think a lot of people would be a little bit more open to diving into the product like that. Great question there, Carl. I love the homework. I'll stay on Jared. I'll make sure he brings you a very, very specific number, 6.2 for next week. But meanwhile, going from that question, which is on kind of one extreme of the user spectrum, a very, very sophisticated type question, to another one. This one comes, maybe the handle should be some sort of indication, some clue. This one comes from Beta Ray Bill. I'm not sure what that is, but it's a good one. I like it. I like the handle. He writes, or maybe she, is there some way to use implied volatility to choose your strike when trading options? Well, this is kind of the entirety of this program that we've talked about for the better part of 100 plus episodes, the impact of implied volatility, and of course realize and how we utilize those in the marketplace. But Mark, I can hear your ears kind of turning red from here. I know these kind of questions really tend to rub you the wrong way, so I'll give you pride of place on this one. What do you have to say for our friend here with a creative handle? I'll give him that, Mr. Beta Ray Bill.
In a nutshell, no, there's absolutely no way. Implied volatility is totally worthless. No, I'm kidding, of course. I want to kind of address the very simple way is that implied volatility is how you select strikes and terms and everything. And it is part of the buy-sell decision. So let's skip the buy-sell decision, right? Obviously, implied volatility, when it's relatively high to realized volatility, which it is most of the time, it should be sold. When it's inexpensive relative to realized volatility or forward volatility, it should be bought. In terms of strike selection, there's this concept that Andrew and I talk about called hard and soft delta. All right. Hard deltas are, and delta, if you aren't aware, is the correlation of the option to its underlying. All right. Based on what the pricing model is saying. So what a soft delta represents is an option that is extremely dependent on where implied volatility moves as the underlying moves. These are going to be out of the money options. All right. Hard deltas are deltas that are less dependent on the actual changes in implied volatility. So if you're just coming from an angle of buying options, when implied volatility is extremely inexpensive, softer deltas are typically going to outperform. They basically kind of just out of the money and out of the money options can be extremely effective in those circumstances. And then when implied volatility is relatively high, it makes sense to use a more in-the-money option like, a 65 or 70 delta option. And, the advantage of one versus the other, a 65 delta option and a $50 stock might be $5-6, depending on where the volatility is. And at the low levels of volatility, let's just say that stock, is like a 15 vol stock. That just out of the money option, so the 52.5 or the 55 option may be so inexpensive that a small move up in the underlying can be extremely profitable to a handful of those options. So what I would say is to Beta Ray Bill is it absolutely is important. And in fact, if you go on YouTube, this is going to be a plug for me. If you go on YouTube and search using volatility to trade for direction, there is a 50-minute presentation on this subject that I cover. So it's absolutely worth checking out and taking the time to view. But yeah, really, implied volatility is how we execute strike selection and term selection and buy-sell decisions. It is what makes us the decision to trade an option altogether.
I think he just blew his mind there, sir. But that was good. I mean, I think we've had myriad iterations of deltas on this network over the past few weeks. And last week we had sneaky deltas. This week we have hard and soft deltas. So we have all different kinds of deltas for your listening pleasure here. But yeah, that's a good point though, Mark, about the strikes. And I think a lot of listeners are probably, I was kind of being a little jokingly dismissive of beta ray at the beginning, but I think a lot of listeners have that viewpoint that implied vol is just this one monolithic thing. And a lot of that maybe happens to be some of the platforms you look at. They look at what's the vol. Oh, here's the front month vol here, and here's the vol in June and July. And what they're just quoting there is at the money vol. And maybe we don't do a good enough job on this show of saying, hey, you know, there's different discrepancies. But that's, we quote a lot of at the money vol a lot as well, because that's, you know, straddle runs, that's where all that stuff comes from. But at the end of the day, there are, of course, variances, like you pointed out, in the different strikes. In fact, if you have interest in that, Beta Ray Bell, we do a lot of programs on this network and segments of other shows like the Odd Block and our Options Oddities program that are all about unusual activity. And the reason we highlight that is to highlight the distortions that these types of trades create and the volatility on these different strikes. So if you want to come in and trade, you know, you could sell strikes where people are bidding up the volatility, buy it where they're selling it, and vice versa, and take advantage of leg into spreads at levels you never could otherwise because of these exact distortions that we're mentioning here. So yes, the long answer is a resounding yes. You can use implied volatility to choose your strikes, and I encourage you to check out those programs as well on the network if you're interested in this, or anyone else out there who's interested in that. And speaking of things we're interested in, Jared, I get the feeling, Jared, that you were that kind of student who liked to sit up front and really, you know, you like to wave your hand, say me, teacher, when you ask, because you're definitely trying to please a teacher here. It's only been about 5 minutes, and you've already done your homework. So why don't you go ahead and share with our listeners, as well as Mr. Carl, who gave you the assignment, what you found for that number of VIX term structure.
Actually, I was pretty shy. I would sit in the back with the bad kids, and
you would shoot spitballs. You were that kid? Well,
no, I didn't cause trouble. I would just kind of sulk in the back until and then hand in homework at the end. And anyway, yeah, the median level of difference between 1 month and 6 month VIX futures over the past 5 years, so since March 2010, looks like it was about 3.8 points, and the range ranged from, you know, a negative number up to like 9 points or so during exciting times. So hopefully that gives you a sense of what kind of difference to expect.
All right, that's going to do it. Thanks to everybody who wrote in. I know a lot of others out there are writing in. We'll get to you on a future show. Keep those questions coming. We love to hear from you. Meanwhile, we have to keep rolling right on into our final segment. It's time to open up the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, that music means it's time for the final portion of the show, where we peer ahead into the misty ether of the future and attempt to divine what the vol gods have in store for us over the coming week, a very difficult prospect if you've ever listened to this show in the past. And perhaps we're running up against it, so perhaps we'll start with you, Mr. Sebastian. What are you predicting for the week to come from a volatility perspective?
Well, you know, we've got the Federal Reserve coming, and typically the pattern has been the Federal Reserve, everyone gets worried the Federal Reserve is going to raise rates or something like that. Then on like Tuesday, or Wednesday, the morning of, everyone realizes that the Federal Reserve is not going to do anything, and then they rally the market and volatility gets crushed and runs the entire week. So my prediction, we're going to see a VIX near 18 sometime between Monday and Wednesday, and then we will also see a VIX with a 14 handle sometime next week as well.
Speaking of the Fed, I had a chance down at FIA this week, and this will also be on the network very soon, so listeners can hear it themselves. I had a chance to sit down with the chief economist over there at CME Group, and while we were chatting, I put to him your wager. I said, where do you fall on the spectrum of raise or not raise here in 2015? And Jared, you'll be happy to know that he came in very resoundingly firmly on a definite raise in 2015, and I asked him, I said, what about time frame? I mentioned your double down of the June double down. I said, would you go on with that? And he said, well, looking at the probability of the meetings, the highest probability meeting right now is June. So it sounds like he not only is on board with you, he's on board even with the double down. So what do you think of that, Jared?
Oh, man, that is music to my ears, and is consistent with everything I'm hearing from absolutely the smartest folks in the industry. So, no, you know what? I did actually talk to a trader this week in town who is actually a rates trader, smart guy. He thinks the Fed's not going to move until December of 2016.
Wow.
He has his reasons. I don't agree, obviously, but there's quite a range of opinions out there still.
That's quite the opposite.
Trade.
Yes,
that is what makes a trade. That's why Jared's gonna have to fly to Chicago and buy me a steak dinner.
Indeed,
we'll see.
A double steak dinner. All right, don't forget that, Mr. Jared. Aside from the wager, what else are you looking at for the week to come?
Well, yeah, the removal of that patience language from the Fed statement is the thing everyone's keyed in on. I think that's going to happen. I think that the market's going to price in an earlier move, even more so than it already has by the end of next week. And I think also, the other thing is we're focused so much on when the timing of this first rates move is. But if employment cost index data at the end of April and non-farm payrolls continue to move in a positive direction, I think once we get through the sort of January and February data releases that have all been so strikingly affected by weather and by noise from oil prices, I think we're going to see a lot of strength in the spring. And that the next thing to think about that markets are going to have to digest is what the path and frequency of monetary policy changes will be. And, a lot of people have been talking about a one and done kind of scenario, but I don't think that's consistent with the fundamental economic data. And so if the market has to price in subsequent changes as well, that could really cause some short-term fluctuations and volatility. So one other thing to keep in mind for next week and for the news cycles beyond that is we're going to get to see more news and discussion of one of the favorite or least favorite, depending on how you think about it, news stories of recent years, which is the debt ceiling. That comes back into play, I think, starting next week. So it might be a non-event. I think that's where my money would be. But at the very least, it'll be something that people are talking about.
Yeah, it's almost our semi-annual debt ceiling debate now at this point. It's kind of become I hate to say a non-event, but an expected event. Speaking of non-events, really quickly, I know we have to wrap up, but I kind of didn't get a chance to touch on it last week. We've talked a lot on this show about how non-farms had kind of become a non-event. People were actually starting to instead of hedging into them, actually starting to sell, or at least not be very reticent about selling going into those events. Then, of course, the most recent non-farms we actually saw, the non-farm actually has a chance to move markets again, actually had some impacts. I'm curious, maybe really quickly before we wrap up here, if each of you think non-farms are back? Are they relevant? Are we going to start seeing people actually bidding up vol going into non-farms again, or at the very least not selling going into that Thursday? Or do you think this was kind of like a one-off aberrant event? Maybe Mark, we'll start with you.
No, I think you've got a point, especially after what we saw after the last non-farm payroll. I think you could see people start to care again.
Jared, are you factoring in non-farms again, or are you kind of this is the one-off?
No, I think as an economic data point, they're crucial. As a potential short-term catalyst, I think they're back. The number itself is really noisy, and I think people give too much weight to the first release and not enough to revisions in terms of their calculation. But when it comes out in whatever form of revision, it's definitely more important than say producer prices or Michigan consumer comfort or these other kind of second and third tier releases. I mean, non-farms and I think increasingly wages, as I've said, are the things to watch.
Good stuff. Unfortunately, we'll have to leave it there. Listeners, that's all the time we have for the Crystal Ball segment. But before we go, as always, let's check in with each of my cohorts here on the old Vol Views panel, see what they have coming up that may interest you. Mark, you mentioned one of your webinars on strike selection earlier. What else do you have cooking over there at the pit that may interest our listeners?
Stay tuned. We're going to have an event on the 31st. So we'll probably do a free webinar then.
Good stuff. Free. Our listeners like free. And Jared, what else do you have? So are you giving away all of the BGC research for free as well, kind of to match the freebie deal?
Yeah, right. We've been doing a lot of work lately with particular clients and focusing on specific needs and interests that they have, rather than just stuff for wider release. But I am working on a couple things in a more general interest research area, and taking a look at some emerging markets in particular that have gotten more interesting from an investment point of view in vol, and might have something on that in the next week or two.
Good stuff. As always, surf on over to optionpit.com and, of course, bgcpartners.com to learn more. And on behalf of Jared and Mark, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. If you're interested in some of these interviews and conversations we were talking about, stay tuned to the network. They'll be coming up soon. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.